everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is John Nadler, Senior Analyst with Kitco Metals. John, it's a pleasure to have you here.
Thanks for having us.
I want to get right into your view, and you're a little bit of a contrarian, quite a contrarian, I should say. We're going to talk about gold and the outlook, and you happen to be bearish. How are you bearish? I've had so many people on this show recently who are still pounding those bullet points about money printing and inflation and even hyperinflation. You are taking the other point of view.
I am, to a certain extent, I certainly am. But, you know, the labels that have been applied to me as anti-gold or something of, you know, a collaborator with Ben Bernanke and so on, absolutely do not apply. What I bring to this view is 37 years in this field and an experience that has seen basically all the cycles in gold from the day it became legal to own and trade in this country up to the $850 peak in 1980, back down to $250, and here we are at $1,900 last year. And my view is this. I'm bullish on the case for gold as a core insurance asset in your portfolio. If you have assets worth protecting, I think you're doing yourself a total disfavor not to own somewhere between 6 and 10% in gold.
Okay.
But I am bearish on the case for overloading in gold with the wrong expectations. Armageddon, hyperinflation, the demise of the dollar, the cessation of world trade.
And hasn't that been the you know, the push? Hasn't that been you know, the call to gold, the reason to own it?
It's been the mantra for a lot of the scaremongering out there and the urgings for overloading in gold. But look, factually speaking, a lot of these arguments are shop-worn arguments that don't hold water any longer.
Let's break them down. Let's break them down.
Let's look at inflation in gold.
Okay.
As we know, anybody who happened to buy gold at $850 back in January of 1980, to date, has not broken even and become in the black, so to speak. Because, in fact, if gold had kept pace with inflation, it'd be trading at $2,400 at least.
Right.
And of course, then the arguments are, well, it must have been manipulated or suppressed. Far be it from the truth. So in terms of an inflation hedge, not quite the most effective one. You could argue that oil or perhaps a number of foreign currencies have been a better inflation hedge per se.
Or even stocks, common stocks.
Per se. Now, if you happen to live in Zimbabwe or the Weimar Republic circa in between the two world wars, gold would have been probably the only thing you'd want to hold. But again, I bring the recollection of 1980, the most conservative of Swiss money managers, seeing the inflation levels that they did see back then and manifest tangible inflation at levels that are far beyond what we have today. They were advocating 15% for well-to-do clients in gold. Today, we have a number of people, and large number, who have put 30 to 60% of their assets into gold, expecting the demise of everything.
Right.
And I think that's just plain wrong, and probably it'll come back to bite them.
Now, how about, you mentioned the Zimbabwe, the Weimar. We hear those analogies all the time. Why are they wrong?
Well, because the perception that somehow Mr. Obama is out there cranking the printing press 24/7, or anybody else in government for that matter, Bernanke, the Treasury, whoever, is plain wrong. What the Fed did here is expand its balance sheet. Certainly it's up to $2 trillion. But the process was in parallel accompanied by a reserve increase in banks.
Right.
And of course the banks have sat on the money. We look at the velocity of money, which has totally collapsed actually in the last 3 or 4 years. So the money that's been injected hasn't really been let loose in the economy to create the inflation that people were fearing.
And it's just going to sit there. The reserves just sit there in the banking
system. Perhaps not, but even if we remove that expansion from the balance sheet, we would probably get a resultant inflation of about 4%. Compare that to what we had in 1979, 1980, when inflation, in fact, from 1971 to 79, inflation was averaging an annualized 7.9%. Currently, we're struggling to, be beyond Fed targets, and maybe we'll get to 3 or 4%, but that doesn't warrant you or anyone else putting in 30, 40, 50% of their assets into gold, expecting it to hedge against that out-of-control inflation.
Right. And
so that's wrong.
And the real money printing, which would be from governments' deficit spending, we're seeing austerity now as the feature, the economic policy feature, the fiscal policy feature, all throughout the world, in Europe, in the United States. And that's like money unprinting. That's not printing of money.
In a sense, that's true. And one of the things I would like to bring to your attention is the fact that back in 79-80, we had a global central banking system, which was essentially a microscopic scale Cold War among central banks. They were very antagonistic. They were distrusting of each other. Today, all they do is cooperate and call each other, instantaneously if there's a crisis or a flare-up. So the degree of control they can now exercise to prevent either outcome, hyperinflation or deflation, is leagues beyond what was available to them in 1980.
Right.
And I think they will do their utmost to avoid either severe outcome, obviously because of the fear of social disruptions that it generally brings.
Absolutely. Talk a little bit about the advent of ETFs and the impact they've had. For example, the GLD and the ability of people now to own gold very easily through an equity-like security.
Certainly it's been a boon to the industry. It's been a boon to the asset class because you have a whole new league of would-be owners who previously couldn't really touch gold as an asset class. But I'm cautious on ETFs as well because I think it's not a bear-tested vehicle, a bear market-tested vehicle. It's been a one-way accumulation vehicle, and many see it as just that. But frankly, I would be far happier if the large tonnage that is being held by these vehicles would be in the hands of loyal holders. I call them that because I'm thinking about pension funds and university endowments and long-term retail type of investors. It's not the case necessarily. I think we have a lot of hedge fund sharpies in there who are just looking for the next way to make a buck. And I think that
we've had guys like Paulson, right? John Paulson, who's been very vocal and open about his position and his outlook on gold.
Well, in his case, it's a double-edged scenario too, because while he did and still professes to be quite bullish on gold, he did employ gold in the correct manner last year when his, bets that were gone wrong on B of A were mitigated by the selling of some very profitable gold positions. Had he not done that, I wonder what the portfolio would have looked at the end of the year. So in this particular case, it's exactly the role that gold serves. You put in an allocation in gold, you offset losses in other sectors if they happen by mobilizing this asset of last resort. But to simply put in gold and too much gold with the expectation of performance, now consider what happens to the rest of your assets if gold goes to the moon.
Sure.
That's not what you want.
Right.
But it's the other segment. It's the entree of short-term speculators, the people who are suffering from this buy everything syndrome, and certainly they've been, throngs of them springing up since the crisis in 08, because they need to make a buck. And you've seen days upon days where oil, gold, currencies, the stocks are all bought in concert with the expectation of making a quick buck.
The risk-on, risk-off trade.
Exactly. And it's induced a lot of volatility into this asset that's normally quite stable.
Clearly. Let's talk a little bit about supply and demand. Gold is a physical commodity. The major consumer of that commodity historically has been the jewelry industry, industrial uses, jewelry industry. How does it look in terms of the actual physical supply-demand picture?
Unfortunately, not that good. Because the major components on the supply side, meaning mine supply has managed to eke out 4 to 5% annualized gains year on year, while mining company CEOs are screaming peak gold. Consider that. Scrap supplies certainly find their way into the marketplace every time gold goes above $1,700, and that tells me another thing, that people at a price are certainly willing to let go. And of course, we've had a phenomenon where mine de-hedging has imperceptibly almost, but certainly as of last year, turned into mine hedging, and that could contribute new supplies to the marketplace. Mine de-hedging, by the way, in my estimation, has contributed probably $300 or $400 to the gold price of the
Mine de-hedging is the lifting of hedges. They're buying
the exact
back.
opposite.
Okay.
Basically
Short
closing the hedge
positions.
books,
Right.
which meant buying physical from the market.
Okay.
Quite the inverse of hedging, which had depressed prices because it added new supply. So this is a very much of a watch factor for me going forward.
What about central bank accumulation or de-accumulation?
Well, central banks are a funny animal because, there's a school of thought that looks at them as the perfect contrarian indicator of what the
Yes.
gold investor might do.
They were selling in the mid-90s, right?
Precisely.
$2.50
so
an ounce.
when you look at the brown bottom, as they call it, people argued that, in fact, that's the day you should have bought gold, and I concur. So the fact that they've turned into small net-scale buyers, to me, speaks nothing more than the fact that this is active reserve management policy in progress, that there's certain places like Kazakhstan or Mexico, who say, we could use more.
Yeah.
But you have not had this putative, massive central bank Chinese buying or massive European central bank buying or any other central bank of caliber coming in and cleaning out 1,000 or 2,000 tons from the gold market. And frankly, if people are looking for central banks to be the salvation of the gold market, I think you're barking up the wrong tree. Banks will sell and buy depending on what their own objectives are and how much they want in reserves. Mind you, I think it's worth mentioning that at the end of the day, any number of European central banks currently under budgetary pressure could bring gold to market. Italy, Spain, Portugal, they have...
Haven't we seen a little bit of that already? Hasn't Greece been a seller?
Overtly we haven't, but the specter remains there, and I would prefer that they would go and mobilize this as a collateralized asset for new loans rather than going into the open market and trying to sell, which would not be very welcome by the market in terms of price. But frankly, this is the purpose of gold in the basement, is to in fact serve as the asset of last resort that you can mobilize in a crunch. And that's why investors also hold it. So I think, the jury's out on what central banks do, but I wouldn't look at them as the panacea that solves the gold market's problems.
So the inflation, as you pointed out, running at roughly half the pace or less than we saw at the peak in 1980. Is there some event or something that'll crystallize in investors' minds that, hey, this is maybe not the asset we thought it was, that you feel that would trigger off a selling wave?
Well,
or is it just going to sort of stabilize now?
Ideally, it would, because the volatility in the gold market is certainly unwelcome by the small retail investor who's totally disoriented at the moment. Frankly, I think the perception needs to shift away from performance orientation in gold and looking at its historical attributes, which is that, A, it's a very good portfolio diversifier.
Right.
It can enhance returns. It can lessen volatility because it's countercyclical to normal types of assets. And that it's basically, MSG for your investment cooking. It makes things taste better. And if you don't overload, at that point you lose this obsession with price performance, you lose the obsession with daily gyrations or drops in the event that they do, and you simply look at it as what percentage do I have of my assets in gold. You start treating it more or less like a central bank, where the percentage of gold in your portfolio is more important than what happened tomorrow to price.
Right.
And I think it's a noble cause for people to try to embark upon, because it's been misperceived as this panacea for what ails the world.
Right.
And unfortunately, that's the domain of doomsayers. We go with the fundamentals and this need for life insurance for your other assets. I don't hope to cash in on my life insurance. I'm sure you don't either.
Not anytime soon, hopefully. John, it was fantastic. Thank you very much. Gold, the MSG for your investment portfolio. That's it for now, folks. This is Mike Norman. See you here next time. Take care. Bye-bye.